Let's jump into today's deep dive. We're dissecting a company that, on the surface, might seem quite ordinary, Grainger Inc., GWW. But as we dug into the detailed investment analysis for this deep dive, its true strengths became surprisingly clear. This isn't just about what they sell, but how they sell it, and, well, why that makes them what you'd call a truly quality business.
That's exactly right. Our mission today is really to unpack how a company primarily distributing maintenance, repair, and operating products, MRO, right? Mm-hmm. So think everything from nuts and bolts to safety gear, cleaning supplies, how they've managed to build what effectively looks like an enduring competitive fortress and, generate truly exceptional financial results. The sources we looked at give a really comprehensive view of their business model, their advantages, management, financials, all of it.
Okay, so how does a company distributing, seemingly basic stuff like a wrench or gloves get so strong? At its core, the GWW model is, well, it looks simple. Buy a massive catalog of MRO items in bulk from, over 5,000 suppliers, and then resell them in smaller immediate quantities to millions of customers, 4.5 million active ones. But the genius isn't just the price spread, is it? It's how they turn that transaction into this mission-critical service. Adding value, like inventory management, taking complexity away, guaranteeing uptime, that's the key.
Yeah, and what's fascinating is the strategic thinking behind their dual model approach. They've really figured out that not all customers are the same. So you've got their largest segment, High Touch Solutions, HTS, in North America. That's $13.7 billion of their $17.2 billion revenue in 2024. Big slice. And this caters specifically to large and mid-sized customers. The ones with complex, ongoing needs who care more about service, technical help, and reliability than just the lowest price. GWW serves them with a curated list of 2 million products, a dedicated sales team, and these integrated solutions like KeepStock, basically mini warehouses right on the customer site.
KeepStock. Right. I remember reading about that.
Exactly. And then you have the endless assortment side. That's their high-growth digital-first arm. Think Zorro in the U.S., Monotara in Japan. That brought in $3.1 billion in 2024 revenue. It targets smaller businesses, maybe even individuals sometimes. And it competes on just the sheer breadth of the online catalog. Zorro's got over 14 million products, Monotara over 24 million, plus transparent competitive pricing.
That dual model, it seems incredibly strategic. But isn't it tricky managing that? The high-touch service versus the massive online catalog competing on price. Any risk one cannibalizes the other?
Well, that's the clever part, managing that tension. It really is a defend and attack strategy. The endless assortment piece, with its huge online reach, lets them fight aggressively in that price-sensitive, long-tail MRO market, leveraging their scale. But crucially, it shields their really profitable HTS core from getting dragged into a simple price war. So HTS can stay focused on that deep service model without, having to slash prices constantly.
And what really makes this seemingly mundane business so powerful is how it tacks into behavior, right? Both human and organizational. For those big HTS customers, the real cost isn't the sticker price of a missing part. It's the, catastrophic cost of operational downtime. Imagine a factory line stopping for want of a 50-cent bolt. Speed and reliability directly fix that huge pain point. Plus, procurement folks always want fewer suppliers, right? Reduce complexity, cut costs. So GWW isn't just selling parts, they're selling, operational insurance. Been doing it since 1927. And it's telling that, over 75% of U.S. orders are online now? Shows they've adapted incredibly well.
And that leads us right into GWW's economic moat. One source called it a truly formidable fortress. It's built on two main things that reinforce each other: scale-based cost advantages and high customer switching costs. With $17.2 billion in sales, their purchasing power is just immense. But maybe even more important is their distribution network. It's incredibly efficient. 34 distribution centers, hundreds of branches. Trying to replicate that. Prohibitively expensive, takes ages. Their own tech, their logistics expertise, it lets them do next day, even same day delivery. Smaller guys just can't compete on that service level, not at that cost.
So scale helps them operate cheaper and faster. What about the switching costs? How sticky are these customers?
Very sticky, especially the HTS ones. GWW gets deeply embedded in their operations, their e-procurement and EDI platforms, for instance. Grainger's system literally plugs into the customer's own purchasing software, like SAP or Oracle. So ordering can be automated, approvals instant. Ripping that integration out, that's a major, costly IT headache. And then services like KeepStock vending machines. GWW basically takes over a chunk of the customer's inventory management. That makes them even harder to replace. Add decades of trust built on reliability. Switching becomes a really big, risky decision.
It sounds like these two moats, they're not separate, they feed each other, a kind of virtuous cycle.
Exactly. Scale lets them invest heavily, hundreds of millions in supply chain tech automation. That investment leads to better service. Better service makes customers sticky, very loyal. That sticky, predictable revenue then funds more investment, which makes the moat even wider. It just keeps compounding.
You mentioned a good example of this Grainger as a service thing with a multi-site manufacturer. Could you walk us through that again? It really brings it to life.
Absolutely. So picture a large manufacturing company, multiple plants. Their main goal is keeping production lines running smoothly, right? They don't just buy parts from Grainger. They integrate their entire procurement system with GWW's platform, so engineers anywhere can order approved parts easily. Then, on the factory floor, they might have keep stocky vending machines. GWW monitors and refills these automatically. Inventory management, outsourced. Now, say a critical line goes down unexpectedly, the plant manager calls their dedicated Grainger rep. This rep isn't just taking an order. They use their technical know-how to figure out the exact part needed, check stock nearby, arrange emergency same-day delivery. That level of service, it can literally save the customer millions in lost production. So yeah, they're not just buying a part, they're buying efficiency, expertise, uptime, a whole package.
And this moat isn't just sitting there, it's actively getting wider based on the numbers. GWW's HTS segment grew, about 3.25 percentage points faster than the overall MRO market on a volume basis in 2024. And that 75% plus digital ordering in the US, that must deepen the switching costs too, because digital integration is just stickier, isn't it? Plus, the market's still really fragmented. GWW only has a high single-digit share. Huge runway left to grab share from smaller players.
Exactly right. Long runway for growth.
Okay, let's shift to the scuttlebutt, what real customers and employees are saying. It's interesting, this tale of two customers emerges. On one side, you see online complaints, maybe from smaller businesses or individuals, saying the list prices are crazy expensive, sometimes way higher than alternatives.
Yeah, but then you contrast that sharply with the feedback from the big corporate accounts. Overwhelmingly positive. They praise the reliability, the speed, the huge inventory, how easy it is to use. There's that great quote, something like, "I'm not wasting $86 in employee time to save $10 on a part." They get the total cost picture.
And that difference isn't a flaw, right? That actually confirms their strategy. They're laser focused on that service-first enterprise customer, not the bargain hunter. They know who they're serving.
Precisely. And from the employee side, GWW consistently gets high marks. Great place to work. That 2021 study had 86% of employees agreeing versus only 57% for a typical U.S. company. That's a big gap. People mention a welcoming culture, good benefits, PTO, 401k, and a focus on well-being.
But it's interesting, you also hear about the tough side. That meat grinder description for distribution centers or permanent crunch mode in software development. How do those things square up? The demanding work versus the high employee satisfaction. Is it just good pay and benefits or something else?
That's a really good question. The analysis suggests it's a mix. Yes, the work, especially in logistics and tech, is intense, no doubt. But the culture seems to emphasize clear goals, team support, and this shared mission, we keep the world working. That helps. The benefits are strong, sure, but there's also maybe a sense of pride in being part of this efficient machine delivering something vital. It points to strong management, balancing high demands with employee care.
That tees up management and the financials perfectly. The CEO is D.G. McPherson, CEO since 2016, chairman since 2017, but he's been with the company since 2008. And his background, working with Grainger even before joining, it suggests he knows this business inside out. The analysis points to his long-term, owner-oriented philosophy and that relentless focus on customer service. Plus, he owns a lot of stock personally, over $100 million. That definitely aligns his interests with shareholders.
Absolutely. And what really stands out is their capital allocation discipline. It's remarkably rational. Priority one is reinvesting in projects that widen that moat. You see CapEx ramping up $256 million in 2022 to $541 million in 2024, targeting things like automated warehouses, better software. Very focused. Acquisitions are usually smaller, bolt-on deals, and they're not afraid to sell off non-core stuff like they did with Faber and Grainger China in 2020. Shows real focus on high returns.
And the shareholder return side is solid, too. A dividend aristocrat, 53 straight years of dividend increases. That's incredible consistency. The dividend itself went from, just under $6 in 2020 to over $8 in 2024. Steady climb. Plus, they buy back a lot of stock, $1.2 billion in 2024 alone. Shows confidence, boost per share value.
Definitely. And when you look at the overall financial picture, the financial fortress idea really holds up. It's highly profitable, very consistent. Adjusted operating margins were around 15.5% in 2024, which is strong. But the quality ratios are where it gets really impressive. Return on invested capital, ROIC, exceptional. 41.6% in 2024. That's elite territory, meaning they generate huge profits from the capital they invest, way above their cost of capital.
41% ROIC. Wow.
Yeah. And free cash flow conversion, also very strong, about 82% FCF to net income. They turn nearly all their accounting profit into real cash.
Right.
It was $1.57 billion in FCF from $1.91 billion high-end income, a real cash machine. And the balance sheet, rock solid. Net leverage ratio is super conservative, just 0.6x. Debt is tiny compared to earnings. Gives them massive flexibility. And you see these quality metrics generally improving from 2020 through 2024. Just impressive financial health.
Okay, so quality business, strong financials. But what about the price? Let's talk valuation. Mid-2025. GWW is trading at a premium, right? PE ratio of 26-27x, above its 10-year average of around 23x, PFCF around 32x. The market clearly sees the quality and is paying up for it.
That's the assessment, yeah. The judgment from the sources is that the price is fair to moderately demanding. It probably doesn't offer a big margin of safety if you're looking to start a new position today, but if you already own it long term, it's not necessarily so stretched that you'd rush to sell. Maybe wait for broader market jitters to potentially get a better entry point.
Makes sense. Looking beyond today's price, though, where does future growth come from? What's the main engine?
It really comes down to consolidating that huge fragmented MRO market. We're talking over $600 billion globally. GWW only has about a 7% share even in its core U.S. HTS segment. So there's just this incredibly long runway for growth just by taking share from smaller, less capable competitors.
Yeah.
Management's targeting mid to high single-digit revenue growth. Given the market dynamics, that seems pretty achievable.
But every business faces risks. What are the real long-term threats that could actually impair this business?
Well, the big one everyone points to is digital disintermediation, specifically scaled competitors like Amazon Business. Could they replicate GWW's value proposition at a lower cost and basically commoditize the market? That's the fear. Then there's the risk of a long-term decline in U.S. industrial activity, since manufacturing is a big chunk of their sales, about 30%. And lastly, a major operational slip-up. A big IT failure like the Canada ERP issue back in 2016, a major cyber attack, a breakdown in their distribution, anything that severely damages customer trust.
Okay, so let's put on our second-level thinking hats. The market consensus seems to be hold great company, fair price reflects that. And the main debate is around those margins holding up against Amazon Business.
Right. But the contrarian view, the deeper insight from our sources, is that the market might actually be underestimating how durable that high-touch moat really is. First-level thinking just compares prices and assumes Amazon will crush margins. But second-level thinking asks, why haven't GWW's margins collapsed already, years after Amazon Business launched? And the answer seems to lie in those bundled embedded services, the technical help, the procurement links, the keep stock systems. Amazon's standardized model doesn't really offer that deep integration and partnership for operational uptime. GWW is more than just a distributor in that HTS segment. And remember, the endless assortment segment is their weapon to fight the pure price battle, shielding the HTS core.
Okay, let's synthesize this. The bull case, why own GWW? First, indispensable business, providing mission-critical stuff, operational insurance. Second, wide and widening moat scale, switching costs, actively investing to strengthen it. Third, great management, rational capital allocation, that amazing 53-year dividend growth, buybacks. And fourth, it's a predictable compounder elite ROIC, fortress balance sheet, long growth runway through market share gains. Sounds compelling.
It is, but then the bear case, the counter thesis. Digital disruption, mainly Amazon Business, squeezing margins. Valuation is already high, leaving no room for error. Potential secular headwinds if core markets like U.S. manufacturing decline. And operational risk, they rely on flawless execution, so a big stumble could hurt badly.
So for the Red Team Challenge, the strongest argument for why owning this long-term could be a mistake. It comes back to that moat, doesn't it? The idea that the high-touch moat might be more brittle than it looks.
Exactly. The failure scenario goes something like this. Imagine powerful AI procurement tools become commonplace for large companies. These tools could instantly unbundle everything GWW offers. They analyze the need, find the exact part anywhere, source it cheapest from the most efficient shipper. Suddenly, GWW's bundled high-service, higher-cost model looks outdated. Customers, always under cost pressure, ditch the bundle for cheaper, good-enough, tech-driven solutions. GWW gets forced into a pure price war across its entire business. Margins collapse, returns crater, valuation plummets. The wonderful company becomes just another distributor fighting for scraps. It's a plausible nightmare scenario.
A sobering thought. Well, there you have it. GWW, a company in the seemingly unsexy MRO space, but it really shows the power of a strong business model, deep moats, and disciplined management. It's a great reminder, I think, that sometimes the most valuable business insights are hiding in plain sight, in places you might not expect.
Absolutely. And maybe a final thought for you, the listener. Given GWW's story, think about how many other seemingly boring or mature industries might hide similar fortress businesses. Businesses that are just overlooked because they're not glamorous. What if the real gems in the market aren't the flashy tech stocks, but the essential, often ignored companies that literally keep the world working? Something to chew on.